So the message was that the firm is in terrific shape, driven by great performance. That's the real foundation of our business, delivering great returns. And we've done that across real estate and private equity and credit and hedge funds. And because of that, we've had big inflows. So we had $120 billion of capital come in just over the last year, a record. We've got a record pipeline of $150 billion of assets going forward. And when we look out, that's translating into strong financial results. So we told folks earnings are going to be accelerating going forward. And not only will they be accelerating, the nature of those earnings is changing. And so the way they're changing is as we move more and more into longer duration vehicles, what we call perpetual capital, we get more fee-related earnings, more predictable earnings. And so we think that combination of faster earnings growth, more predictable earnings, steadier earnings will give the opportunity for a re-rating of our stock, which, as you said, has been a bit of a source of frustration for us.
Yeah, and it's something we've discussed a bit in the past. I mean, you have one great slide in the many that you presented today, which shows this very significant percentage increases over the last 4 years in AUM, in a number of other important metrics, and only a 9% increase. I mean, today you're practically up 50% from the 9% increase that you had over the last 4 years. I know it's a frustration. Do you feel like you've done enough to address it?
Well, I think this is a process. Today was a really important part of that. Educate our investors, the research community, about the way the firm's changing. And so, yes, I think we got the message out there that growth is picking up. I also think we got an important message out that the firm has fundamentally changed. If you look back a decade ago, you'd say this is a firm just really in private equity, real estate private equity, and it's really expanded, broadened the way we serve investors and do it in all sorts of areas. And that broadening, I think, makes this a more robust firm. And yes, from a valuation standpoint, when you look out and say we have the highest dividend yield of any of the 150 biggest companies out there, we traded a market multiple that's a third lower than the rest of the market, we do say this is a heck of an opportunity. And as insiders, we own 50% of this stock. So we're totally focused on maximizing value.
Right. Now, some will come back and say, well, one of the reasons you traded that discount is you're not a C-corp. KKR, as we know, decided to move that way. You continue to study it, but it's not something, coming into this meeting, frankly, there were people who expected perhaps that would be the major news item. Why not have said we're going to do that as well, given what has been a very positive market response to KKR's move?
We've definitely seen what's happened to their stock and others, and we've been impressed. And we're looking at it closely. We said, I think, on the board, actively considering. But this is an important decision. We want to be thoughtful. We'd like to see sustained stock price performance. We'd like to see what happens in index inclusion. We'd like to see in terms of mutual fund ownership. It's something we're open to, but we're still studying.
Asset flows are so important, and it's something that you, of course, focused on today, perpetual and or otherwise, the increase in AUM that you've had versus many of your competitors. What gives you the confidence those kinds of flows can increase or continue at the rate that they currently are?
I would say the key thing, again, is performance. And what we showed today was it didn't matter if it was private equity or real estate or credit or hedge funds. In all of those areas, over long periods of time, we've outperformed the benchmarks and over the last 12 months. And that's what really drives flows. If you deliver for investors, they give you more capital. The second thing I'd say about this is the markets we serve are enormous. The institutional market with pension funds and sovereign wealth funds, the insurance market, the retail market. Add up those three, $150 trillion. It sounds like a lot that we have $440 billion of capital, but it's still a tiny percentage of those markets. That gives us a lot of confidence.
Right.